Good morning. How are you both doing today? I know you wanted to meet to review the $600 that you wanted to start investing monthly to achieve your goals. In previous conversations, you have stated that you like to assume moderate risks with your investments. Capital accumulation is a primary concern in this stage of your lives, and the protection of principal, income production, and reductions of taxes are of minor importance. Right now, with your current financial situation, I would recommend investing $600 in a money market account. The reason being is on your statement of cash flows, you have zero in savings. With an annual living expense of $35,210 and debt payments of $24,900. Let me explain why I believe putting the $600 towards a money market account is the best option for you. If something was to happen to you and you lost your stream of monthly income, you would have no emergency fund. Yes, you have in total liquid assets $7,500 in a joint checkings and savings account, but your emergency fund would be anything over your total monthly expenses. Breaking down your annual living expenses, debt payments, and property taxes to a monthly payment, you would need to pay a little over $6,000 a month to cover all those expenses, meaning that you would only have about $1,500 in an emergency fund. The rule of thumb for an emergency fund is 3 to 6 months of fixed and variable monthly expenses, and it depends on the situation. For the two of you, 3 months of income is sufficient. The reason 3 months of income works for your situation is because you are married and are both gainfully employed. An emergency fund should be kept in checking accounts, savings accounts, money market deposit accounts, money market mutual fund accounts, or time deposits that are close to maturity. I would recommend investing that $600 to a money market mutual fund so that if anything happened, you would have a liquid investment that you could easily turn to cash. The money would be safe and you would have a chance to get a better return than if it was just sitting in a checking or savings account at a financial institution. Investing them in a money market mutual fund adds protections to your overall portfolio. I know you mentioned taking the $600 and putting it towards a Roth IRA. While Roth IRAs are an option for future tax-free distributions, I do not believe that it would be in your best interest to do right now. If you were to invest $600 monthly, you would not be able to put the $600 towards one Roth IRA account. You would have to split the contribution and open up a Roth IRA for the both of you. Remember, they are individual accounts. $600 times 12 is $7,200. In 2021, because of your age, you would be allowed to contribute $6,000 to a Roth account with the $1,000 catch-up contribution, making the total contribution that you are allowed to make $7,000. You would not want to contribute more than the annual max because you would be penalized on the over-contribution in that Roth IRA. The IRS will tax you on the amount that's over, and they will keep penalizing you until you make the correction. If you open a Roth account now and say in 2 years something happens and you realize you need to access the money, the distribution would not be considered qualified, and it would not be considered a qualified distribution if it has not been at least 5 years from the beginning of the year for which you first set up and contributed to the Roth IRA. Any distribution before that 5-year mark would not be a qualified distribution, and the portion of the distribution allocable to earnings may be subject to tax, and it may be subject to the 10% additional tax. In a Roth IRA, there are no age limits to contribute if you have earned income, but there are different rules for when you want to take money out of the account. A qualified distribution is not subject to tax or penalty, but if you wanted to draw on your Roth account before 5 years or before the age of 59 and a half, you could be subject to tax or that additional 10% penalty. Looking over your portfolio and your current financial standings, I believe that building your emergency fund and investing in a money market account is the best option for the two of you at this time. In a couple of years, if your financial situation changes, we can reevaluate how that $600 a month is being allocated, but for right now, Let's build your savings and adjust accordingly. A financial plan is not set in stone. I will monitor and we will adjust as things change. Please let me know if the two of you have any questions. It was so nice to see you both, and I'm more than happy to review any part of your plan.